Let's review some shocking housing market updates. We'll talk about Washington, D.C. We'll talk about Vegas, and perhaps a growing trend that I'm hearing from more and more real estate agents across the country. We will talk about the economic week ahead. We will review some Fed speak, and we will also give you a surprise update that, yes, I was finally able to interview Grant Cardone. Folks, if you've been on the channel about 3+ years or so, you might recall that Grant Cardone sent out a message on Instagram, basically in the depths of the pandemic, saying, hey, if you want to have a podcast with me, reach out. And I did. Unfortunately, at the time, this channel was much smaller and we were declined. We were said thanks, but no thanks. The good news is I saved my 3 questions. So I had 3 questions that I wanted to ask that I had believed no one had ever asked him before. And after our interview last week, which will go live tomorrow at 4 p.m. Pacific, he admitted that no one had ever asked him these questions. So I want to thank Grant for coming on and allowing me to go back in the time machine and ask him kind of 3 hard questions. So that was a lot of fun. Again, it will go live Monday at 4 o'clock. So let's talk about some housing market updates. There are a lot of people talking about Washington, D.C. Obviously, the mass layoffs and whatnot that are occurring there will undoubtedly hurt the housing market. Several people have reached out to me and asked, what do I expect? Well, it's really quite simple. I expect Washington, D.C., that kind of metro, to very much be like Phoenix, Arizona, when all the iBuyers left. Now, you can go back and look at the charts. It's pretty clear when all the iBuyers left, right? Inventory skyrockets, demand collapses, and there is price degradation. Washington, D.C. could see double-digit price declines this year. They really could, right? If we're talking about 20,000 people in and around D.C. that are no longer employed, there's a very good chance that a lot of them will have to move to get a job, right? If the federal government hangs up a no openings or no vacancy sign, these people are going to have to leave. So there will be price degradation. There will be rent degradation. Evictions will go up. It will be, frankly, a bad year in and around the D.C. area. It's going to be a rough year. It clearly looks that way. Let's talk about Las Vegas. I was reading a Las Vegas article. That's actually where I'm speaking to you from as we get ready for our Vegas event. Las Vegas homes, so single-family homes, ex-condos, ex-townhouses, just single-family homes, set a historic price record in January. January is not the month I think of when I think of price records. So the historic record goes all the way back to May of 2022, where the record was 482,000. January, the month that just finished, 485,000. Now, again, if you just look at that number and you don't dig a little deeper, you probably are asking yourself, what the heck is going on? Well, folks, as I have been telling you for 2, possibly 3 years now, the housing market is broken. And when I say that, I mean transactions are low. And when you have artificially low transactions, you can get some price distortions, you can get some inventory mix, you can get all of these things that yank the median price higher. And again, the last thing about price is last January, it was 445,000. Again, this January, 485. So that is a 9% increase in the median home price. Active inventory is up 47% year on year, so a meaningful jump for the Vegas Valley. However, sales are tiny. They're under 2,000. Under 2,000 homes sold, single family. Again, these are all single family numbers, ex-condos, ex-townhouses. 1,991 were reported by the Las Vegas Journal. So again, very interesting to look at. Yahoo Finance put out an article, which I think they may have got the topic from this channel, and that is talking about the consumer. Consumers might finally be accepting higher for longer mortgage rates. I think this is absolutely going on. We saw this and we thought about it for the first time with Beth Traverso up in King County, aka Seattle, talking about bidding wars. We've had validation in Chicago and other areas that buyers are active. And what that means is, again, consumers are remarkably predictable. What we have learned and now have validation, 7% bad, 6% good. Today, with mortgage rates in the low sevens, you could easily get buy downs and points and be in the mid sixes. And people have starting to have enough. And this is just the beginning. This is just the beginning. We've had 2 or 3 years where people are staying put, they're renting longer, all of those things. Again, I believe that 2025 will be the last hard year. So that means we will have another year of people just sitting tight, waiting, getting the bunk beds and, all of those things. So nothing has changed my mind. I still think we average 7% for the year. I still think this year existing home sales are below 4 million. And I think 2026 is going to feel amazing if you are in mortgage and in the real estate game, especially if you are paid on transactions. So there you go. Folks, we are 6 days away from the start of our Vegas event, our second annual celebration. If you still haven't got your tickets, you're really lucky. Yesterday was the final day of cancellations or whatever, refunds or whatever you call it. So there's 1 or 2 tickets out there and available. If you want to come, you can go to Eventbrite. If not, no big deal. I am all focused on getting material and agendas and all of that stuff together. So make sure you do get the virtual event. It's $99. You can watch it. You'll get the recording. You won't miss out. So again, make sure you do that. Let's talk about the economic week ahead. We will be focused on Fed speak, more of that in a minute. On Tuesday, big day, we got 5 various Fed members speaking. Wednesday, we will get CPI, aka the first of 3 inflation readings. Just so you have the expectations. The expectations, again, we told you this was coming. Inflation is expected to finally go down, right? Headline inflation, I believe, has been going up 3 months in a row. We now have 3 months where this month is the first of 3. So this is the first of 3 where the tailwinds should be positive. We'll see. So headline is expected to go from 2.9 to 2.8. Core is finally, I think it's been 5 months, 4 months. Core is finally expected to go from 3.2 to 3.1. On Wednesday, we will have 4 Fed speeches. So Tuesday and Wednesday, 9 Fed speeches, undoubtedly market moving. PMI will be our second inflation reading of the week. That comes on Thursday. Both headline and core are estimated to be 3.3%. We will also get weekly claims, which again, I don't remember what last week was. I think 226. Again, we're staying below that number. Friday, we will get retail sales, right? What's going on with our consumers? Are we still spend? And we will close out with 1 Fed speech on Friday. It looks like the mega cap, the Magnificent Seven, are out to spend $300 billion. $300 billion on capital in the AI race in 2025. That's a lot of money. Crazy. Let's talk about some Fed speech. We got Kashkari, Goolsbee, Barkin, and yep, that's it. So Kashkari expects lower rates later this year. Again, folks, something that we're starting to at least see, in my opinion, is more and more Fed presidents are taking March rate cuts off the table. I need to go check out what the Fed Watch tool says, but I'm guessing the March rate cut odds are falling. Goolsbee, rates to move lower in the next 12 to 18 months. Could we have no rate cuts in 2025? Maybe. Kashkari, again, inflation down. Labor is staying strong. that will move me to more rate cuts, which that doesn't make sense to me. Let me repeat that again. I actually wrote myself some notes here so I wouldn't miss this point with you. Kashkari is saying is if inflation is down, right, which again we're expecting for the next 3 months, and labor stays strong, he is willing to cut. So, okay. So inflation down, jobs stay strong, he's cutting. What happens if inflation down and the job market weakens? They cut. What happens if inflation's not down but job market weakens? They cut. So Kashkari, what you're telling me is the job market doesn't make sense. You want to cut. That's what Kashkari is telling us. He is clearly a dove. It makes no sense to me why he would say that. But hey, he wants to cut. If you're in the real estate game, you probably would welcome that. But remember, they don't control mortgage rates. They control the very front end. So again, what Kashkari is saying, in my opinion, is it doesn't matter what's going on with inflation. They're ready to cut. If inflation's down, they're cutting. Barkin, I see a strong consumer spending and lower investment in 2025. I don't know. Hasn't the consumer been spending like drunken sailors already? Do you think that's really going to continue? I guess we'll see. And finally, Goolsby, the threat of a trade war and messing with supply chains is a very real threat. And again, folks, that is something we should be watching, right? These tariffs, these tools, these negotiations, all the theater, pomp and circumstance really means nothing unless the supply chain gets wrecked. We should all remember what happens if the supply chain gets wrecked. That is not a very good opening. I do want to thank a couple of people real quick. Jim, Steven, and Owie. You have all joined school in the last 48 hours. Thank you for doing that. Again, you 360 or 360 to 370 folks going the same direction. I appreciate you joining. Make sure you introduce yourself, unlock all the goodies and free education at level 2 and level 3. You won't regret it. I also want to thank Mark. Mark went out and bought one of my swag. He bought the Do the Work hat. Yes, folks, I sell some swag, some hats, some shirts. Don't talk about them a lot. But Mark, thank you for buying the Do the Work hat. I appreciate it. What else do we got? Goldman Sachs. Goldman Sachs is worried about a correction in the stock market due to high valuations and less friendly macro environment. A couple of last points. Yesterday, I did a quick live stream talking about losing 19 pounds in 7 weeks. Again, I did that because I'm on a health journey. I want to keep you all updated. You can go ahead and watch that video. I think it's 15 minutes, but I'll give you the highlights here. No GLP-1, no TRT. I simply tracked what I was eating, right? Shout out MyFitnessPal, not sponsored, just what I'm using. Also have an Oura Ring. Again, not sponsored, just using it. I'm tracking versus guessing. I always went by feel before. Now I'm tracking everything I put in my mouth and eating, as well as tracking sleep, heart rate, all of that. Number 2, I am walking more and running less. As you all know, I was training for a marathon last year, which we succeeded in. But when I was running 70, 80, 90 miles a week, I was eating trash because I was starving all the time. And that did not stop when the marathon running stopped. So again, that's why I ballooned up to 218. And now I'm spending less time in the gym. I'm not doing 5 sets of 10. I'm doing lighter reps and going to failure. I'm comfortable going to 30, 35 reps. Again, I'm not doing ego lifts. I'm an old man, not made of plastic like 20-year-olds. Walking has been a huge part of it. I do 100,000 steps a week. I don't do daily goals because if you have one busy day, you can wreck your week. I go ahead and do 100,000 for the week. And then finally, thanks to Jason Khalipa. Jason Khalipa was the fittest man on earth in 2008. He highly recommend GoRuck. Again, not sponsored. GoRuck so I could add some weight when I'm walking. So I went ahead and got that. I've had it for about a week. I'll let you know. I bought a Go Ruck bag plus a 40-pound plate. It's basically a backpack. So I am walking around at roughly 250 pounds, which is it's a lot harder than you would think. It certainly gets the sweat going. So again, that's what I'm doing. And the final thing we'll talk about is, again, what I believe is going on right now is our attempt by our government to bend the curve on our runaway deficit. This is something we should all be hopeful for. Everyone, blue, red, left, right. If we don't fix our national debt, which is currently running away at about $2 trillion a year, none of this matters. What we are trying to do is bend the curve. And again, you can only bend the curve one of three ways. You can increase revenue. Think taxes or tariffs. You can reduce expenses. Think grift, theft. Think Doge for what they are doing. Or you do both. And that is what is going on today. And again, if we can get it to bend the curve, if you can get this to bend the curve, folks, the market will reward us. We will have lower rates. And guess what happens when you have lower rates? The runaway deficit goes lower because we can stop financing debt at 5%. We could finance it at 4.5%, at 4%, at 3 3/4. That too will lower debt. It will be a self-perpetuating loop, which will be good for all of us. The All In podcast, which again is something I listen to Saturday mornings when I go for my long 20,000 step walk, estimated that there might be $600 billion to $1 trillion in theft, grift, abuse. That's not okay. That is simply not okay. We have been blinded to the grift. We've accepted the grift. No more. Sunlight is a great disinfectant. And frankly, I am looking for people to go to jail. This is wild what is going on. All righty, folks, have an amazing day. It is Super Bowl Sunday. I actually have no interest in either team, so I doubt I'll watch it. But hey, if you're an Eagles fan or you're a Chief fan, have some fun. I hope it's a good game. I hope it's not a blowout. You know what? If you're watching this, let me know what your favorite commercials are. Super Bowl commercials are always fun. Let me know below. And then finally, if you're coming to Vegas, travel safe. We will see you Saturday and Sunday. If you're meeting Matt and Dion and Mike at the midnight Denny's runs, have fun. They are a blast. Take care of the waitress, whoever's serving you. And just have a good day. I hope you have a good day. Later. Like, subscribe, comment. Bye.